So today, we are going to answer some questions about cash value life insurance policies. We've got an individual interested in a whole life insurance policy with a focus on cash value. What he wants to do is really maximize the cash value so we can use it later for real estate and business. He had two specific questions that we're going to at least cover in this video, which are number one, can I access my cash value anytime? And number two, are there any penalties? So the answer to the first question, can I access my cash value anytime, is yes. So when it comes to accessing the cash value, so you can start a policy, let's say I start today and I want to access money tomorrow, can I access it that early, one day after starting a brand new policy? Typically, no. I usually have to wait at least 10 business days. You will find that a lot of insurance companies want to make sure that the funds clear from my bank account before I can turn around and take out loans. However, here's what I want to emphasize when it comes to accessing the cash value anytime, because the answer to his question is yes, you can access your cash value anytime you'd like. However, how you can access it initially is through policy loans. There are two ways in which you can actually take money from your life insurance policy, two transactions, I should say. One is a policy loan, the other is a policy withdrawal. So, hitting on loans first. Most insurance companies will allow policy loans to be taken anytime. You will see with some carriers that I have to wait at least 10 business days after I make a deposit until I can turn around and take a policy loan. Now here we've got a bullet point. First year, do the numbers make sense? And what I mean when I say that is when you first start a policy, what's the cash value going to look like? Let's say you pay in $10,000. Will your cash value be $10,000? No, it will be less than $10,000. Let's say it is $8,500. So you paid in 10, you have $8,500, that's a $1,500 loss before we look at any loans. If you're going to take a loan in the first policy year, or any year for that matter, what happens? You're going to have interest, a cost to borrow that goes to the insurance company. So when I ask this question in the first year, do the numbers make sense? Specifically, what I'm interested in making sure someone is aware of is the fact that I'm negative initially, because that's where the insurance company is going to make the majority of their profit. And then number two, I'm also paying them loan interest. So if I isolate that first year and I'm laser focused on the cash value, when I pay money in, I have a negative hit, plus I have a cost to borrow, that's loan interest that goes to the insurance company, that can inflict financial pain. So I want to make sure that I'm aware of that and comfortable with it, or I might be aware of it and say, you know what? I'm going to wait a couple years until I see positive cash value growth here. Then I'll begin to take out loans because I want to make sure I'm always positive. Always depends on your situation. What I like to make sure of is that we can see the numbers up front before we make a decision there. So back to his question, can I access my cash value anytime? The answer is yes. You can take out loans anytime you'd like. On the topic of withdrawals. So when you take a policy withdrawal, it is like withdrawing money from a checking account. Once you pull money, it is no longer earning interest. So for example, if you have a whole life insurance policy, we'll pretend you've got cash value of 100K. Let's say it's earning 5%, just for simplicity. If you withdraw $50,000, how much do you have left? If we take 50K, we would have only 50K left. And because we withdrew that amount, now only the 50K remaining is earning 5%. Whereas with a policy loan, this functions more like a line of credit against a piece of property, assuming the property is always appreciating. So when we look at a policy loan, how this works is let's take the exact same scenario. Let's assume you've got cash value. We'll pretend here it's also earning 5%. You take a $50,000 loan. There's a cost to borrow. We can say that's also 5%. So what happens here? Well, on the policy loan, $50,000, 5%, $2,500 of interest. That goes where? To the insurance company. However, you'll continue to earn, in this example, that 5% on the full $100,000. So there's no lost opportunity cost there. We continue to move forward. Now there's a bit more to that. You also see your death benefit drop by $50,000. There's more items to be aware of, which I would check out any of our videos that break down how policy loans work. We go through loan charts and we have a lot of fun. But there's two ways to access money. Loans anytime, withdrawals. We can take them typically as early as the 8th year. You can take them often beginning policy year 2. The thing is, if you take a withdrawal during the first 7 years, that can often trigger a MEC, only because a withdrawal will result in your death benefit dropping. And what's important to note about that is if we drop the death benefit in the first 7 years, that MEC limit will drop. So if I have a policy where I funded up to the MEC limit, and then I want to take a withdrawal, the death benefit will drop, resulting in a MEC. Now that's easy to prevent because we'll get a warning before that transaction actually occurs. But my point is, if we want to take withdrawals, usually after the first 7 years makes the most sense. And where people often exercise withdrawals is usually in retirement, where they want to use their cash value as a means to generate income. So specifically, what we'll do is first take withdrawals up to our cost basis, call that CB. Your cost basis represents your total payments over time. So if I paid in $10,000 per year for 10 years, I've paid in a total of $100,000. Let's pretend that by the time I want to start taking income, my cash value has grown to $200,000. So I paid in 100, the cash value is 200,000. I can take withdrawals up to the 100K without triggering any taxes. If I withdraw more than my 100K payment, my cost basis, it will be taxed as ordinary income, even if the policy is not a modified endowment contract. So in retirement, what you'll often see is individuals will withdraw up to their cost basis, and then they'll begin to loan out the rest without repaying that loan or paying any loan interest. The agent needs to make sure that the policy is never at a risk of lapsing, because that can happen if we take out too much in policy loans. But if you do things right, you can take income tax-free from life insurance policy, and life insurance has been used for that purpose for a very long time. And then penalties was the last question. Are there penalties if I access my cash value? So with the whole life insurance policy, the answer is no. There are no penalties. However, what I like to mention, because I found people appreciate this, is if I'm going to take out loans, there is loan interest. That's money that goes to the insurance company. So people do view that as a cost. Sometimes people want to know penalties, costs, fees, meaning money that I pay out of my pocket to the insurance company. What is that? So there's no penalties for me accessing the cash value. However, there's loan interest. And the other thing to be aware of that some people view not really as a penalty, but on the same train of thought, is the fact when I start a policy, if I pay $10,000 in the first year, or pretend the policy is designed for maximum cash value, my cash value might be $8,500, which no matter how I spin that, that's a loss of how much? $1,500. So if I pay in 10 grand and then I cash the policy out for whatever reason, we wouldn't recommend it, but let's say that happens, I cash it out after the first year, I lost $1,500. So one could feel like they're penalized or they took a hit of $1,500 in that first year. Now we want to make up for that quickly, but I do like to mention that as far as additional information. Hope this was helpful. Let us know if it was. Feel free to leave any questions or comments below. And as always, I hope this helps.